I welcome you to this Navigating the Future conference. Let me first introduce you the purpose of these 12 sessions. So we'll first start with all the key elements that are impacting your business that will transform your business. We want really to go into every several element of your business and analyze what will be the impact. I will invite the first team, which is about business model transformation. As you know, we are always talking about this new concept, the VUCA world, and we would like to go a bit deeper and to understand what are the different transformations in the business model that you can see. So while you're listening to this presentation, try to think about what are the business model transformations that you are facing right now in your business. Try to understand what's coming. Are you ready to take over this new transformation? Is your company ready to take this transformation? So now I invite Alex and Alistair to come on stage and introduce you this first topic. Thank you.
So good afternoon, everyone. I'm Alistair. I have the pleasure of taking you to this journey and start off by introducing the subject of business model transformation. We're living in an ever-changing world that's affecting all of us. And with that, we're going to see how these business models across different industries are changing day by day. I'm going to start off by introducing the concept of VUCA, and how companies are using different strategy by being proactive or reactive to tackle their issues and deal and navigate through these ever-changing environment that they're operating in. We're going to look into several examples later on, look into financial services, then we're going to move into process industries, and after that we're going to finish by looking into infrastructure and how the infrastructure models are changing. So, this is the real world. Often, without doing anything wrong, you might even fail. And why is that? We are going to look into the concept of VUCA. What is VUCA? VUCA is volatility, it's uncertainty, it's complexity and ambiguity. This is the world we are living in today. The world that's very complex, it's very ambiguous, it's very uncertain, and it's more volatile than ever before. It's getting harder and harder for companies to navigate through these environments. Now, if you actually look at the data on average lifespan of a company, we see that this has changed through the years drastically. In the past 30 years, we see that the companies are living shorter and shorter. Now, let's think of disruption. Disruption is a topic that we talk about often. But what is disruption? How do these disruptive companies come into play and change the complete business model? Are we going to get a copy? Yes, there will be a copy. Yes. No need to take notes, yeah. So let's look at the curve of disruption. The companies that are disruptive, they start very slow. They have low quality use. Their performance is not great. But if you think about their curve, they have an exponential curve. Once they start to pick up, they become the norm of the industry, and they take over. And they become the dominant player in whatever industry that they're working in. Now, think of some examples. Wikipedia came in 2001. And before that, we have Encyclopedia Britannica. I don't know if you remember that. I remember my grandfather had, God knows, 30, 40 volumes of Encyclopedia Britannica. But now that encyclopedia was replaced by Wikipedia in a short span of 10 years. We have so many other examples in different industries that shows how these disruptive companies came into play and took over the norm. Now I'm going to take you to a different journey. Let's think of two companies that started together, Fujifilm and Kodak. These were the companies that have the same product. Now look at their shares. Fujifilm was able to actually sustain its business, whereas if you remember, Kodak went completely out of business in 2012. What happened here? So, as some of you might know, the digital cameras came in. Digital cameras completely changed the business world of film and photography. A company like Fujifilm was reactive to this adoption, and they were fast to respond. When they responded, they decided to diversify their offerings, and they moved into healthcare, moved into documents, moved into high functional materials. whereas Kodak was a bit too late, and they had a doomed destiny, and they had to file for bankruptcy. So I want you to remember, when the changes comes, some companies, they're fast to react. And if they don't react, and if you're late to react, then you might actually be out of business. Now let's look at the different data. We're seeing that the global mail business is in decline. We had almost 5% decline over the past few years. And now if you look at the e-commerce turnover in Southeast Asia, we see that it has been increasing by almost 30% in a very short span of time. Now we have a proactive company. Singapore Post looked at the data and they decided to be more proactive. By being proactive, they moved into e-commerce business and they became an e-commerce powerhouse. And they moved away from the traditional mail service. Now Singapore Post today generates almost 35% of its revenue from e-commerce alone. And that only happened in the past few years. At the same time, they were fast to react. And they were proactive in the industry that they moved in. And they were able to catch on a trend that we see today, almost 53%. We see a 53% year-on-year growth in the e-commerce related businesses alone. Now, up to now, we talked about how uncertain the world we are living is. We introduced the concept of VUCA. We talked about how some companies are proactive, some companies are reactive. Now I want to take you to the financial services. Let's look at fintech. We often talk about fintech, but what is fintech? Fintech in a nutshell is the use of technology to address inefficiencies in the financial services and create solutions that are desirable to user, to clients. If you look at the data, for example, McKinsey thinks that by 2025, almost 60% of the profit of traditional players, banks, financial institutions, will be at risk just due to the appearance of these fintech companies. What are the attributes of banking versus fintech companies? In banking, we have low switching costs. We have a highly competitive environment, and more importantly, we have ever-growing regulations. Some of you are from banking industry, and I know you're suffering right now. The banks today, they are operating on a fee-based business model, and that's where most of the profit is coming from. Now, if you look at the fintech companies, they're only IT intensives. They don't have any real estates, their costs are much lower, and they're almost offering the same service, and they're targeting the fee-based sector. The fintech companies, more importantly, they have access to the customer data. Once they actually lock in the customer, they have their behaviors, they have their data, and make it much more difficult for these clients to move away from whatever platform they're offering. What they do, they lock you, and then they offer better and better service, and they come to the point that their service is so great that you have no intention of leaving. We are dealing with a lot of uncertainties in the banking industry, and the fintech companies, they're able to address some of them. More importantly, we're talking about digital revolutions, a trend that we see the traditional financial institutions are very slow to respond to. Now I would like to show you how this competition works with fintechs and how these companies are operating. If you think about the fintech world, or more broadly, an IT-intensive world, you see that these companies start like that. So think of Amazon, for example. They start by looking at the landscape, look for areas to improve, to optimize. Once they move in there, they're able to assess the landscape, and they improve their business model, they improve their offering, and they move into a completely different section. Industry restructuring. And once they are able to restructure the industry, they become the dominant force in that market. So think about Amazon again. They came in, they started offering a service that didn't exist, they figured out their business model, and at the end they became the dominant force in the market they were offering. And that's where we think the fintech companies might go. Now, if you look at two different services that traditional financial services are offering, the retail payment is on this very end site. So if you think of retail payments, now you already have Apple Pay, you have Google Wallet, and these companies, they're able to offer a new a new service in terms of non-cash payments for the clients and make it so much easier for them. Now, the banks were very slow to respond, and they're only catching on the train right here. Now, because they're so slow in response and they've already missed the boat, I would say they can only use partnership, they can only use M&A, and they have to partner with these companies because these companies are already very far. However, if you think of wealth management side, and we think about robo-advisory, there are not that many companies that are offering those services. They're not very successful yet. And this is where the traditional institutions are able to play very well because they have a client base and they can offer almost the same service that a lot of these fintech companies are offering. And even if they can go and use acquisition and create the same platforms. Now, I want you to think about the overall business model here. When do you want to be reactive and when do you want to be proactive? If you can find out where to be proactive, where to be reactive, and use the right strategy, you can protect your core business. If you think about being proactive, you can always be proactive when the switching costs are low. When there's not much going on yet, the industry is trying to reshape, and you have a high margin to play. But if you think about being reactive, you are at the point that the clients are reluctant to change and switch platforms. You have new trends that are already in place, they've been tested, and there are other players that are using them. In that case, if you want to protect your core business, all you can do is to react. And you have to react fast, otherwise you cannot protect your core business. With that in mind, I'm going to switch to my colleague who's going to talk about process industries. Thanks.
Thanks, Alistair. We're going to move into more traditionally capital-intensive industries. So we're going to talk about process industries and infrastructure. If you think about the volatility in the process industry space, we're thinking companies in steel, chemical, pulp and paper, just as examples. There's a lot of price volatility on the inputs. Half of their outputs are commodities, so they're squeezed on price. There are other volatile points such as regulations. We're not sure where environmental regulations typically just get tougher and tougher. So just with a quick background in mind, we're going to look at a quick example of what the traditional business system is for some of these companies to get the products in the hand of the customers. Some key success factors for these players include where do you place your factory, because that's a big decision you have to make up front. Where do you source your materials? Do you own it? Do you buy it? How do you use automation in this new digital trend to help you become a more flexible player and quicker to react to the market? And how do you secure your access to markets in the future in terms of sales and distribution? If you look at Industry 4.0, a big topic we talk about these days, it's enabling these process industries to become more flexible. For example, to be able to ramp up or scale down their production, which traditionally was not easy to do. It's hard to just stop a steel factory and start it up again, for example. What Industry 4.0 enables you to do is use the digital factory, use the industrial Internet of Things, control your factory from 2,000 kilometers away, and become that flexible player. But in order to do that, you need to be proactive. You need to be investing upfront into technologies that will help you down the line, and maybe not immediately. The proactive players can be the first to market. They can scale up and down. They can create new innovative products that can command higher margins. But you can also have the strategy to be a reactive player and wait to see, should I invest in such a big capital plant that's fully automated? What risks or what failures have occurred? What can I learn from that? So that's kind of the strategy you need to decide as a player. We want to give you an example of a proactive company and a reactive company. If we think about Bao Steel, they've been around for 40 to 50 years. They're the fourth largest steel manufacturer in the world. Given the environmental trend of oversupply of steel into the world economy, they decided to still invest $8 billion into a new state-of-the-art facility in China, strategically placed. What they can now do is retool their factory in 2 days. They can now scale up and scale down their production. They can create products that they think their customers are going to need down the line because they are the experts in their products. This is a big bet that they've placed, and it may take a couple years to realize the benefits of it. If you think about a reactive player such as Burroughs Paper Corporation, they've been around for more than 100 years. And throughout the 100 years, they always believed they were proactive. Unfortunately, 2 to 3 years ago, they were hit with some fees due to safety concerns and accidents in their manufacturing. And so although they thought they might have been the most modern player, they realized that they were forced to react due to some unfortunate circumstances. So this is when we take a quick moment to recap process industries, and we think proactive, reactive, just to make the point, this is a strategy. You don't want to be forced to react, as Burroughs had to do. You want to make the decision, like Bow Steel did, to be proactive for the next coming years. We want to give you one more industry example, in also capital intensive, in the world of infrastructure. If you think about infrastructure in this VUCA world, it's a very complex contract with the hope to secure cash flow for the next 20 to 30 years. So it's not such an easy thing to just build an infrastructure project. So with that in mind, we wanted to start with some macroeconomic trends that we think are impacting the space and changing where the investments are coming from, mainly from the traditional public sector to include more increasingly so the private sector. If you look at on the left-hand side, US public investment, for example, into infrastructure, that has been on the decline in the last few years. If you look at the next trend of low interest rates, especially in the last few years that are near zero in the US, you have a cheap access to capital, but what do you do with it? What do you want to invest in? If traditionally bond yields overall are lower than they used to be, what's going to be an attractive investment for you, especially if you're an institutional investor who needs to secure long-term returns? This is where we think infrastructure comes in. Based on the World Bank and other analysis, statistical assumptions, there's going to be a $60 trillion need for infrastructure projects in the next 15 years. This is the demand, but are they good projects? Will they be built? Will the private sector really invest in the $60 trillion? Right now, there's a forecast that the investment shortfall will still be $20 trillion, and these are in the next 15 years. So given this demand for infrastructure projects, where's the money going to come from if the public sector has been investing less and less? We think that institutional investors, such as pension funds or sovereign wealth funds, they have been building up their assets under management in this space. Just in the last 5 to 6 years, they've doubled the assets under management from 150 billion to about 320 billion. So this is on the increase. Why is the private sector, such as the institutional investor, interested in this asset class? There are various reasons, including it's a safe hedge. It gives you a 30-year steady cash flow. It helps you meet your pension obligations. It's good. It's counter economic cycle. And it also has a high impact on economic development. The governments definitely need these kinds of projects, so they should be willing to collaborate. But this is the point. In order to see this increasing shift in private sector spending, you're going to need to rely on government. You need to rely on some sort of partnership to drive this investment. So far, public-private partnerships only account for 1% of infrastructure needs. It's not enough. So our point is just if it's really up to the government to say, hey, we're ready to restructure the contracts to spread the risks correctly, then we can shift the risk on the left-hand side when it was traditionally from the government sector bearing risk, subcontracting portions, to completely letting the private sector bear these risks. We think that if they manage to restructure the contracts to be in the middle, you'll see this shift in the industry towards more private sector investments. And this is our last point on infrastructure. To trigger this major change, governments need to understand that they need to be the ones to suggest enough projects that are attractive to the private sector. They need to explain how you're going to implement this project over the 20, 30 years. Only then can you rely on this traditional framework where you share the risks and you share the returns. Just as a quick example, we spoke with an executive of a bank 1 or 2 weeks ago who mentioned that the bank had billions of dollars ready to invest, and after looking at different governments and speaking with them, they felt that there were not enough attractive projects and the policy landscape was not ready for them to invest. So in this case, the institutional investor is reactive and waiting for the government, but they can also, provide unsolicited bids and say, hey, we're interested in this, but you need to act. You need to change this policy landscape so that we share the risks and share the returns. Infrastructure might be a very specific example, but if in your industry you need to think about entering a market where the regulatory landscape is not ready for you, you may need to be the one reacting. You might need to be the one waiting for the government to make that move. So this is where we start to wrap up our first presentation. What we want to say is, intuitively, being proactive seems to be the better option. Might have been for Bow Steel. It's a big bet that they took. The institutional investor infrastructure might need to wait. So we saw some examples on both sides. But we just wanted to reinforce the point of proactive and reactive is a strategy. You need to decide if that's the way your business is going to operate. You don't want to be forced to react because that's not a strategy. You don't want to make a decision when you're stuck in the middle when this pendulum is swinging left and right, because that's when you're forced to make a decision that's not on your own terms and not in line with what you really want to do. So to conclude, it's important to act at the right time. When we think about the VUCA world, the boom and bust cycles seem to be happening faster and faster. The disruptive player might go out of business as well. So you need to be able to understand these players and what this pendulum looks like for the other players in the industry as well. And so back to what Ralph's question was for you on what's your first target segment. What's your target segment and when do you need to act? Do you need to hold the cash in your pocket or do you need to act now? Thank you.
Question time.
Any questions? Please. Microphone. Oh, it's coming.
Hi, my name is Anne Zhang, MBA 2002. I have a quick question. So if I understood correctly, you pretty much look within the industry how this is going to, what my business model is going to look like and how I'm forced or I'm proactively looking for changes. But have you also looked at the examples of now, because now you have a lot of disrupting technology or newcomers who will actually disrupt the industry in a way that is actually cross the industries. So as a company, do I choose to stay in the industry? So for example, Google is changing everything, right? Tesla, a newcomer, is changing the car industry or new energy. So how I, as a company, what I'm going to anticipate that? That's my question. Have you looked at examples or if you have anything to share? Thank you.
I think the only example, first of all, I think it's a great question. As we said, the VUCA world is very uncertain, and we have a lot of companies that are entering and making it more and more difficult. So the only example we kind of looked into was Amazon. And Amazon is really changing the landscape of several industries all at the same time. We didn't go deeper into those examples, but what we saw in a short study was that these companies, they start by becoming very strong in the industry that they originally disrupted, then they're able to move into other industries. And that's why we focused on a certain part and how these companies initially start to be disruptive in the industry that are initially are. So if you think of examples like Tesla, like Google, first they were really good at their core business, and then they started moving into other areas.
Airbnb and Uber.
Again, if you think of Uber or Airbnb, they are platforms, and they're platforms that they're disruptive. So they're disruptive companies. They're moving through the curve that we've shown, and what they're focusing on, for example, on Uber side, it's transportation and passengers. So they're only disruptive at least initially. They were only disruptive in their industry. Now they're moving into electrical cars and so on and so forth. So this was the angle we took. We didn't really look into how they're moving into cross industries.
One point also on Google, I think we mentioned, is it Apple Pay and Google Wallet?
Yeah.
So if you're too late to react to that trend, you're almost going to be forced to partner with that player. So that's one point. On Airbnb, maybe the example there would be hotels are going to start renting out to Airbnb as well just to fill their occupancy rate. How do you beat that player? I guess that's the big question that we're waiting to see. I mean, is one technology startup going to replace another? We see that there typically is only one or two players that end up winning in that space as well. So is there going to be Uber and a Lyft 5 years from now, or is there only going to be one company? We can also ask anyone from our team if they have insights on this one. Bro? Okay, one second.
Hi. I think this is a question especially about defining exactly what your strategy and your core business is, and when do you react. In the two cases we've cited with Airbnb and with Uber, Airbnb has been around for 10 years now. It was very much under the radar for a long time. And so this is what we're trying to say in this presentation, is that when these players come about and they seem to be threatening your core business, for example, that's the time to react. Do hotels then want to start working with residential properties and start to rent them out as a side business? They tended to ignore that, and now they're at a position where their business is really being threatened, and they see their revenues disappearing. So Uber, I'd argue, is at that stage right now, where they're starting to take over the taxi cab market, but will they take over shipping, transportation? What else could they move into? So this is really for a company to define how big of a player is it in its industry. Does it have influence? What's its core strategy? Does it choose to protect, for example, its core customers and really try to find a niche market like SingPost did? Or does it try to expand into a new market? Does it have the power to partner with other players in its industry to protect against someone like Airbnb and Uber? Thank you.
I have a question here.
Go ahead.
You're making the case that reactive is a strategy by itself. It's a decision you make. The point is, you need to be reactive or proactive at the company level, or you can be more a portfolio and pick, on this business I'm going to be reactive, and that business is going to be proactive.
Well, I can take a shot at it. I did come from GE, where we have different industries, and if I was mainly in one or two, so I'm trying to think, was one more proactive and one reactive? I think, in my case, all the divisions I saw, there were different timings. So sometimes one was proactive, they thought they were proactive, and they realized that they were not as proactive as they thought. So one particular division said, we need to change our business model. On the other hand, aviation, for example, said we need to start charging by the hour, so of airtime, our engines, if the engines are flying in the sky, that's when we charge, and we don't take a huge CapEx sale up front. So they started this business model, and it takes a while to reap the benefits of that. So I think within the different business units, we did see different strategies between proactive and reactive. I think for aviation, it did definitely help and pay off. But I think that decision should lie within the industry experts of that division. If they really understand the competitive landscape the most, if they have their own customer segmentation, that proactivity versus reactivity should come from the division lead, and I think that the power should lie there when they make their investment decisions.
Thanks.
I have I think it's very good to watch you guys doing the presentation, because we also came from similar background. We are 1998 class, we were being grilled by our professor. You guys are speaking too fast. I don't know whether it's because Ralph is watching the clock.
There's one up there.
Okay, so I'm trying to ask the easier question, because you talk about the 60 trillion gap in the infrastructure needed. You particularly talk about PPP. This is something that China is doing a lot at the moment. And when you talk about VUCA, for me, that you're talking about China. That's everything you talk about. I think that really you can summarize what the China is doing at the moment. But they do a lot of PPP. So what I want to know is, when your research and your analysis on the PPP, you talk about the best practice of the benchmark, and what are the cases you are using it now? Because I'm very interested in knowing more.
We have some experts.
Yep, we'll pass the mic now.
Thank you very much for your question. We have seen that over the last year, China has invested a lot in infrastructure and is fostering a lot of PPP projects there as well. But when we talk about China, although they have a lot of PPP, they still use the government companies to do it. So although we are talking about a public-private partnership, we still have a very high participation of Chinese companies backed by the government in infrastructure assets. What we're trying to talk here a little bit more is because the gap that we have now in infrastructure, that is about $20 trillion over the next 20 years, must be fulfilled somehow. And the Chinese companies are having a very important role in this model. For example, in Africa, which companies are going out to Africa to build infrastructure there? Mostly Chinese companies. And they're doing this, bringing the Chinese exporting money facilities, and doing this, they are helping to foster infrastructure in China, in Africa. And I think that China is gonna play a really important model, but we can't forget, for example, that Japan, over the last 20 years, invest a lot, almost 10% of its GDP in infrastructure. But although they built first-class infrastructure, they couldn't boost their economy doing this. So it's a two-way around. China, of course, is gonna play a central role, but must take care about those investments in a way that it's gonna build it's gonna help the world to meet the infrastructure requirements. Okay. Yeah. Okay. For example, we can talk about when you are going to a country and you are trying to implement a PPP. And in some cases, the companies goes there and they are very concerned about the structures that they're gonna do to set up the business. But they forget that infrastructure is not only about setting up the business, but also creating the best regulatory framework that we can carry over 30 years of the project. So a best practice will be, for example, to sit down with the government and try to adjust the regulation in a way that they will be secure over their 30 years of their investment. So something very important in this case would be to sit down with the government and discuss the right regulatory framework.
I think we only have time for one more, so. Okay. Please.
My name is Ray Quinn, EMBA 2000 and something.
Welcome.
I happen to work for a firm that's in the design consulting business around the built environment. We do a lot of transaction advice in the PPP area, mostly in the US. So I can talk about successful projects and models that have been implemented there and in other places in Europe and Australia. I would say, though, that the legislation, even in the United States, isn't yet completely in line with what it needs to be in order to free up the market to use the PPP model widely. There are a number of states and a number of locations where it works well, but not all. And so I think the legislation, at least in that economy, which I know better than most, is still a long way from being ready for the model to be rolled out broadly. But several states, several projects, very successful models.
Thank you.
Well, yeah, I mean, on this topic, I think the World Bank a couple of years ago launched the public-private IAF, so Infrastructure Advisory Fund. So their idea is to bridge this gap, but it's also fully dedicated to making sure that the policy changes do happen. So living in the US as well, I can see that, especially living in the Midwest where the snow destroys our roads. It takes a long time for any infrastructure project to actually happen. And understanding that the model is still very much the government runs the project and they subcontract out, and it may take a long time for that project to happen. So given that the US has dropped their investment to 1% on infrastructure, will that change? If they don't have any room in their budget, they're gonna have to rely on PPPs. And so the regulatory change should happen. And I think the World Bank is trying to make sure that it does happen.
That's it.
Thank you.
Thank you.